You know, major political events can send some serious shockwaves through the global economy. But what happens when that shock hits a system that's already kind of stretched to its breaking point? Well, that's the question we're digging into today.
I mean, it's a fundamental truth, right? Whether you're talking about engineering or economics, you push anything far enough and eventually you're going to find its limits.
So today, we're going to run a kind of stress test, all based on our source material. We're exploring how a major political succession right here in the United States could ripple through the markets and really define the rest of the decade.
But first things first. To really get the impact of a shock like this, you have to understand the starting conditions. So what does the US economy actually look like in early 2025, right before this hypothetical event?
Okay, so what's really interesting about this slide is the story it tells. On the surface, things look all right. GDP growth is slowing down a bit, but still positive. Unemployment is pretty low. But if you look just a little deeper, you see the cracks. Inflation is stubborn, the deficit is high, and interest rates are way up there. The key takeaway is really right there in that little note. The economy is stable, but it's brittle. It's running hot for sure, but there's just not a lot of cushion if something goes wrong.
And that internal brittleness is getting amplified by all these external pressures. The U.S. is trying to navigate a world that is just full of flashpoints. You've got ongoing tensions with China, the war in Ukraine, major instability in the Middle East. It all adds up to a global system that's totally on edge. This is the fragile environment our shock event is about to land in.
And that brings us to the event itself, a political shockwave that's going to transmit almost instantly through the world's financial markets.
So here's the scenario our source material lays out. It's the middle of 2025, and there's a presidential succession. President Donald Trump is unable to continue in office, and so Vice President J.D. Vance is sworn in. Now the constitutional process itself is clear, but the future of U.S. policy? Suddenly, that's anything but. And boom, the market reaction is immediate, and it is fierce. First you look at stocks. The S&P 500 just plunges 6% in 2 days. This is a classic whisk-off moment. When uncertainty spikes like this, investors just dump risky stuff like stocks and run for cover. It's a total sell first, ask questions later kind of vibe.
At the exact same time, you see this intense flight to safety. The yield on the 10-year Treasury bond, which is basically the global benchmark for what's safe, drops like a rock. Now remember, when yields go down, it means prices are going up. That's because investors are desperately piling into U.S. government debt, willing to take lower returns just to know their money is safe.
And finally, to complete the trifecta, look at the dollar. The U.S. dollar index just spikes. This shows that even in a moment of American uncertainty, investors from all over the world still rush to the dollar for its incredible liquidity and its perceived safety.
You put all that together, the stocks, the bonds, the currency, and you get this, a massive volatility shock. It's the financial system's knee-jerk reaction to deep, sudden uncertainty.
So into all this chaos steps the Federal Reserve. They move fast to basically be the adult in the room. They put out statements, they expand liquidity to keep money flowing, and, this is the most important part, they signal a change in their thinking. Suddenly, market bets for interest rate cuts jump from 1 to 3 for the year. The Fed is calming everyone's nerves by showing it's ready to step in.
Okay, so after that initial heart attack in the markets, the world enters a new phase. It's not really a crisis anymore, but it's this deep and unsettling pause, what you might call a policy vacuum. And you can feel that pause hit the real economy and hit it hard. I mean, when the future is this unclear, businesses just don't invest. Capital expenditures, that's money for new factories and equipment, they drop an estimated 8%. Mergers and acquisitions, which are a huge sign of corporate confidence, they fall by 20%. The economy's engines are starting to just idle.
Meanwhile, the rest of the world isn't just sitting on its hands. They're watching, and they are calculating. America's allies, they offer public support, but privately, they're worried. China? They see a potential opening, a chance to reset relations, but on their own terms. And Russia uses the moment to sow confusion and discord. Everybody is just waiting to see which way the new administration is going to turn.
And this is where the analysis gets really fascinating. Because that initial shock, it creates an inflection point. It's a fork in the road. And from here, our source material charts 3 very, very different potential futures for the U.S. economy, leading all the way to 2030.
First up, we've got Path A, policy continuity. This is basically the stay the course scenario.
The new administration doesn't make any radical shifts. In this world, that initial shock just fades away, markets get back to normal, and the economy gets back on a track of okay growth and slowly easing inflation. You can think of it as the baseline.
Then there's Path B, policy escalation. And this one is, well, exactly what it sounds like. Here, the new administration responds to all that uncertainty by becoming more confrontational. Maybe they jack up tariffs, which ignites global trade tensions, and the result? Inflation comes roaring back, forcing the Fed to keep interest rates high, which leads to slower growth and higher unemployment. Not great.
And finally, we have Path C, policy normalization. This is the optimistic path. In this scenario, the administration pivots toward pragmatism, toward stability. They work to smooth over trade disputes and push for bipartisan fiscal deals. And the markets? They absolutely love this. Uncertainty plummets, investment comes back, and the economy nails that soft landing with stronger growth and stable, low inflation.
All right, this dashboard right here, this is the analytical heart of our entire explainer. Just look at the differences by 2027. Under the escalation path, inflation is still hot at 3.5%, forcing the Fed to keep rates way up at 4.75%. Unemployment jumps to 5.5%. Now compare that to normalization, where inflation is back on target, rates are much lower, and unemployment is a super healthy 3.8%. The crucial point here is that the policy choices made in that first year after the succession event create these vastly different economic realities.
So what does this all boil down to? What's the ultimate takeaway here? Well, that initial market shock, as dramatic as it was, it actually wasn't the deciding factor. What mattered way more were the policy choices that came after.
And you've got to understand, those choices don't just affect numbers on a screen, they totally reshape America's place in the world. The escalation path leads to a more fragmented, a more contentious world where U.S. influence actually shrinks. The normalization path, on the other hand, reinforces U.S. leadership and global stability. We're talking about two completely different worlds. There's a quote from the source material that just nails it. A moment of succession reshapes not just policy, but the entire trajectory of the decade.
So in the end, this analysis brings us to a really powerful conclusion. The initial event, it creates uncertainty. That's the first shock. But it's the leadership and the policy choices made in response to that uncertainty that truly determine the path that follows.
And that leaves us with the central question, not just for this scenario, but really for any moment of crisis. When stability is put to the test, what path is chosen? The answer to that question defines everything that comes next.